So in 2025, the markets were telling two completely different stories. I mean, one was a story of just historic, massive gains, while the other was, well, it was one of frustrating stagnation. But what if they aren't actually separate stories? What if they're just two chapters in the same book, and we're all just about to turn the page? Today, we're digging into the big question. Will all those massive profits made in gold and silver be the rocket fuel for crypto's next major run?
Okay, let's just start with this number, 150%. That was the absolutely staggering return for silver in 2025. I mean, it shattered records, it turned heads, and it became one of the biggest financial stories of the entire year, outperforming pretty much everything.
And then you have Bitcoin. Over that very same period, it was actually down about 11%. A pretty brutal underperformance for the asset that so many people call digital gold, especially when its physical cousin was having its best year since 1979. So what gives? I mean, how can two assets that are supposedly hedges against the exact same risks move in completely opposite directions? Well, the answer boils down to one incredibly powerful concept in finance: capital rotation. And trust me, understanding this is the key to figuring out what could happen next. All right, let's dive right into the story of this major market divergence that we all watched unfold throughout 2025. This wasn't just random noise. It was a crystal clear signal about where investors were putting their money and, maybe more importantly, why.
To really get this, we need to think about two kinds of assets, right? So on one side, you've got your defensive assets. Think gold and silver. Their whole job is to preserve your capital. When fear is running high in the markets, investors sprint to these for safety. Then, on the other side, you have offensive assets like Bitcoin and the rest of crypto. Their purpose is all about capital growth, and they really thrive when investors are feeling confident and, ready to take on some risk.
And in 2025, the market was absolutely 100% playing defense. We had escalating geopolitical tensions, huge concerns over government debt. Just this general cloud of uncertainty sent a flood of money pouring into those traditional safe havens. Gold and silver got the call up to the big leagues, while Bitcoin, well, it got left on the bench.
So what's really the engine behind these huge capital shifts? It all comes down to one absolutely crucial concept that honestly drives everything in modern markets: liquidity.
Global liquidity, it sounds complicated, but it's really just the total amount of capital sloshing around the financial system. The best way to think about it is like the ocean tide. When liquidity is high, the tide is coming in. It tends to lift the price of all assets, especially the riskier ones. But when it's low, the tide goes out, and things can get pretty ugly.
And the people who control this tide, well, that would be the central banks, mainly the US Federal Reserve, and they've got two main tools. There's quantitative easing, or QE. That's when they turn the money faucet on, injecting cash into the system. And then there's quantitative tightening, or QT, which is the exact opposite. They open up the drain to pull money out, usually to fight off inflation. Now, for the last couple of years, that drain has been wide open. But a really critical shift just happened in early 2026. The Fed announced it was ending its QT policy. By stabilizing its balance sheet at around $6.5 trillion, it effectively closed the drain. Now, they're not opening the faucet just yet, but they have stopped actively removing liquidity. And that one move changes everything. So now that the Fed has pretty much officially closed that liquidity drain, it's the perfect time to look back and see exactly where all that defensive money flowed in 2025 and really understand the forces behind that historic rally in precious metals. It wasn't just one single reason. You see, it was more like a perfect storm of factors all hitting at once. We saw a massive buying spree from central banks all over the world. Geopolitical tensions were running super high, pushing investors towards safety. Silver had its own unique thing going on with the surge in industrial demand. And then, on top of all of that, the market started pricing in the idea that the Fed would eventually have to cut interest rates.
Okay, now what's really fascinating here is the sheer scale of the central bank buying. For over a decade, their average was about 473 tons a year. In 2024, they bought over 1,000 tons, more than double the average. This wasn't just regular investors hedging. This was entire nations diversifying their reserves away from the dollar, which created this massive price floor for gold. And silver's incredible run, it was basically supercharged by its dual identity. Yeah, it acted as a safe haven right alongside gold, but it's also a critical industrial metal that's essential for things like solar panels and electric vehicles. So with demand absolutely booming and the market facing its fifth straight year of a supply deficit, the price really had nowhere to go but up.
So let's recap. Investors have locked in some historic profits from all these defensive trades. The Fed has officially stopped draining liquidity. The big question now, the multi-trillion-dollar question becomes, where do those profits, that newly freed up capital, go looking for their next home? This right here is the core thesis. As market commentator Anthony Pompliano put it back in late 2025, the conditions are becoming ripe for a great rotation. We're talking about a potentially massive flow of capital out of what's now a very crowded gold trade and into a lagging Bitcoin.
And look, this isn't just some wild theory. It's a pattern that is actually played out before. Typically, it happens in 3 phases. Phase 1, fear takes over, and money rushes into metals. Phase 2, that rally starts to cool off as investors begin to take their profits off the table. Then, phase 3, as risk appetite slowly starts to return, that same capital, the exact money that was just sitting in gold, goes hunting for higher returns. And historically, it often rotates directly into assets like Bitcoin. Now, what makes this potential rotation so explosive today is all the modern market infrastructure we have. Right now, there is nearly $300 billion just sitting on the sidelines in stablecoins. Think of them as digital dollars that act as a bridge between old-school finance and crypto. This is dry powder, capital that can be deployed into Bitcoin or other crypto assets almost instantly.
But, and this is a really big but, this rotation is not guaranteed. Its path is completely dependent on what happens in the wider economy. And as we're about to see, the fate of this entire rotation rests almost entirely on the shoulders of one single institution. So the crucial point here is that Bitcoin's path in 2026 isn't really its own. It's almost entirely hinged on how the Federal Reserve responds to the economy. CoinShares lays out 3 really distinct possibilities. First, you have the Fed panic scenario. This is where a sharp recession forces the Fed to just slam the stimulus button and start printing money again. In that world, Bitcoin could soar above $170,000. Next is the middle path, a mid-cycle expansion. Think kind of sluggish growth where the Fed cautiously cuts rates but doesn't panic. Here, the price target is a very healthy $110,000 to $140,000. And finally, the worst-case scenario, stagflation. That's where you get weak growth and rising inflation, forcing the Fed to keep policy tight. In that world, Bitcoin could really struggle to break past $100,000. So the stage is set, the historical pattern is clear, the liquidity drain has been plugged, and all that capital is just sitting there, waiting for a signal. The framework is in place for a massive capital rotation. The only question left is, will history repeat itself? So what do you think is going to happen? Is this great rotation already underway, or is this cycle really going to be different? Let us know what you think down in the comments. And hey, if you want to keep making sense of these complex market shifts, make sure you subscribe for more explainers just like this one.